Imagine if your investments paid you the same way a job does. Instead of waiting years for stocks to grow, you receive money regularly, month after month, just for holding certain investments. This concept is often called the monthly paycheck strategy, and it's built around dividend-paying ETFs. For investors looking to generate consistent income from the stock market, this strategy has become one of the most popular ways to build passive cash flow while still participating in long-term market growth. At the center of this strategy are dividend ETFs, which are exchange-traded funds designed to hold companies that pay regular dividends. A dividend is simply a portion of a company's profits that is distributed to shareholders. Many large and established companies share part of their earnings with investors every quarter, and some funds even distribute payments every month. When you invest in a dividend ETF, you are not relying on just one company to provide income. Instead, the ETF holds dozens or even hundreds of dividend-paying stocks. These can include companies from industries such as healthcare, consumer goods, energy, banking, and telecommunications. Because the ETF collects dividends from many companies, it can distribute those payments to investors in a more stable and predictable way. The key idea behind the paycheck strategy is income scheduling. Some dividend ETFs pay distributions in different months of the year. By combining multiple ETFs that pay at different times, investors can create a system where income arrives frequently throughout the year. While it may not literally be every week, the idea is to design a portfolio where dividends are consistently flowing into your account. Another reason this strategy is attractive is risk reduction through diversification. If you buy shares in a single company and that company decides to cut its dividend, your income disappears. But with an ETF that holds many companies, the impact of one company reducing its dividend is much smaller. The overall fund can continue paying income because other companies are still generating profits. Dividend ETFs are also known for including companies with strong financial stability. Businesses that consistently pay dividends are usually well-established and profitable. They tend to have predictable revenue streams and mature business models, which makes them less volatile compared to younger, high-growth companies. One powerful feature of dividend investing is compounding. Investors can choose to reinvest their dividends instead of spending them. When dividends are reinvested, they purchase additional shares of the ETF. Those extra shares then generate their own dividends in the future. Over time, this process can significantly accelerate portfolio growth. For example, an investor who continuously reinvests dividends over many years may see their income increase steadily as their share count grows. What starts as a small stream of income can gradually turn into a meaningful source of passive cash flow. However, it's important to remember that dividend strategies are still connected to the broader stock market. ETF prices can rise and fall, and dividends are not guaranteed forever. Companies may adjust their payouts depending on economic conditions and business performance. That's why many long-term investors focus on funds with a history of stable dividends and strong underlying companies. These ETFs often prioritize businesses with healthy balance sheets, reliable earnings, and a long record of paying shareholders. For investors seeking a balance between income and growth, dividend ETFs offer a compelling solution. They provide exposure to a wide range of companies while delivering regular cash payments that can either be reinvested or used as income. The weekly or monthly paycheck strategy is not about getting rich overnight. Instead, it's about building a steady and reliable stream of income from investments over time. By using diversified dividend ETFs and focusing on long-term compounding, investors can gradually turn their portfolio into a source of passive cash flow that grows alongside the market.